Good morning, traders and investors. Roger Scott here, senior strategist for the Trading Pub. It's Monday. It's about 7:36 in the morning. It's Thanksgiving week. And boy, oh boy, oh boy, it's about, let's see here, 7:36 in the morning. We're not going to get to open up for another hour and 54 minutes. I'm here nice and early for you with a briefing for this morning. Now, before I get started, if you haven't done so already, I got something in my eye. If you haven't done so already, please subscribe to our Telegram channel. If you don't know where or how or what, just go to rogerscott.com/Telegram or go to our YouTube channel, go to the search bar, type in Roger-Scott, you'll see our channel, and it's below every morning video. There's a link to it there, all of the information. And also make sure you like these videos, subscribe to this channel, and give me some feedback. I haven't heard feedback from you in such a long time. All right, now let's begin. And by the way, before I begin, I have a class today, a Pro Trader Dashboard class that launched last month. It's happening at 1 p.m. Make sure to click the link below this video. All right, now let's get into all the juicy details. Took me a minute to get through all that. And again, thank you for all the emails. It's been really great hearing from you. If you want to reach out to me, roger@rogerscott.com. I do respond to every email. So you could see here that the futures right now, let's just go to futures. Let's start off with the usual. You could see right now that the Dow Jones is down 9. Nasdaq is up about 22. This is randomness. This is not here, not there, nothing really going on. Also, if you look at the energies market, we heard some positive news over the weekend that they had a ceasefire, but energies are actually up, which is kind of counterintuitive. But with the war, they've been tumbling down. So this is really interesting. We'll have to keep an eye on that today. Now, interestingly, as you know, it's a holiday week. This is one of the biggest holidays of the year, and a lot of folks are going to be taking the entire week off, and a lot of folks are going to be taking Tuesday, Wednesday, Thursday off. So I'm not expecting this week to be very turbulent. Now, remember something. The worst things we could do is create a certain set of expectations for ourselves that will not happen. So I don't want to do that. But generally speaking, the overall, we want to tune out, kind of look at the big picture. The big picture is not a lot of follow through, more swings, less day trading, because volume is going to be low. And if there's no volume, you don't have a lot of commitment. So we're going to have to focus on stocks for day trading this week that are extremely strong. Otherwise, they're going to be switched to swing trades because we're going to need that extra day overnight price action. As far as the big reports this week, you've got FOMC minutes. That's going to be tomorrow. You've got existing home sales. I'll talk about home sales and real estate in just a minute. You've got durable goods, you've got jobless claims, you've got consumer sentiment. But again, I don't expect these reports to have as big of an impact on the market this week as they usually do. And as far as FOMC minutes, the response, the reaction hasn't been all that great or negative. It's been kind of muted, and I'll tell you why. We already know what they're going to do. The bond market is doing the heavy lifting. We know they're at the end of the cycle. There's not going to be any major surprises here. I could pretty much tell you exactly what they're going to say. Things are looking good. We're making progress, but we don't know definitively how things are going to go in the future. We may have to take more adjustments, but things are working, and what we've been doing is working. Because the funny thing is, it happens to be the truth now. 8 months ago, 6 months ago, 5 months ago, they were saying the same thing, and numbers weren't getting any better. So nobody really knew what the hell they were talking about, and they were just straight up buying time. But now we're getting to a point where what they're saying and the reality is finally starting to match up. So unless Powell says something really shocking, and I don't think he's going to. I think he's going to say exactly what I just said. Things are getting better. It's clearly making an improvement. We're not there yet. We may have extended rates far longer than we expected, but we're probably near the ending phase, maybe one or two more. But again, we're not in the beginning. We're in the end. So that's very, very important because remember, markets are always driven by what we know ahead of time that's discounted into the market currently. So again, I'm not expecting a big Fed response. So the next question is, what's the biggest trigger for end-of-year rally? And I think it's the fact that investors are hopeful that interest rates are not going to go higher, and they're banking off of that. Now, as far as earnings are concerned, I'm going to give you the earnings that's expected. I'm not going to get into all of them like I usually do because we're pretty much done with all the big ones. These are the only ones left. So I just figured instead of giving you the expectations, I would give you the implied volatility guide. And in this case, in terms of implied volatility, It's very simple. We've got Zoom. They're expecting 9.2% either up or down. We've got Autodesk tomorrow. We got BBY. We got DKS. We got Low, MDT, NVDA. NVIDIA tomorrow, folks. That's big week for chip stocks. You've got DE on Wednesday, and you've got NEO on Thursday. But again, it's a big week for tech stocks, and NVIDIA, which is probably right now, it is the biggest chip stock, and it's the biggest. It's one of the biggest S&P 500 FANG stocks. So we gotta have to pay attention to it tremendously. And I'll talk about individual stocks, and I'll talk about NVIDIA in just a minute. But as far as Fed data, as far as earnings, that's not what's really driving the market right now. Right now is whether or not interest rates are going to stay at these levels or not. Now, looking at interest rates, let me just make sure I'm not. All right, here we go. Looking at interest rates, you could see we're hovering near the upper end of this range. If we stay middle ground, that means we're not really expecting rates to go up or down, just kind of status quo, which for now is okay. But if we start breaking up, that means there's a clear bias towards rates going lower sooner than later. If we break down from this ascending triangle, it means rates are going to stay higher or even go higher faster than we expected. So keep an eye on this ascending triangle. I personally think we're going to break down a little bit, not up. But again, I'm just going to go with the flow. But I think we've had the upside already for quite a bit, and I think everything is already expected. We already are expecting not to have any interest rates. We're expecting interest rates to start going down next year. So I think it's a little too premature. But remember, the bond market and the Fed, they're not aligned. This is based on personal sentiment, on what investors are doing based on the Fed. So this may be getting a little bit ahead of the Fed, like a lot ahead of the Fed. Because, folks, let's be realistic. Economy, we still have a huge debt. We still have 2 wars on the front. We've got a lot of stuff going on, and I think it's a little premature fundamentally to be thinking that rates are going to be going down. I think it's a lot. And I think investors have a tendency to rush these things ahead of time. So I'm not really seeing it. I'm seeing us more congesting and possibly breaking down. But again, we don't know, and we're going to react based on what happens. Now, as far as the market, let's talk a little bit about global economy. You've got earnings on NVIDIA later this week. Gap and Ross Store had better than expected earnings last week. That's good for retailers. We'll talk about sectors in a minute. Housing starts and building permits were better than expected. This is one of my favorite sectors. I'm going to talk about that too in a minute. Michael Barr, the Fed Vice Chair Supervisor, said that Fed is at near the peak of interest rate hikes, while Dolly and Collins emphasized the necessity of more evidence of cooling inflation. But if they get that evidence, they're going to be saying the same thing that Barr is saying. So they're not far. You're not having half of the Fed says we're going lower and half of the Fed saying we're going higher. That's not what's happening right now. There is now a 29.4% of a rate drop in March, okay? And no probability of rate hikes going into January. And this is why I say I think this is a little too premature. I think we're going to be eating those words. I think personally, the way this is going to look is that there's still a 10 to 15% chance rates are going to go higher in March. And we still have what? December, January, February. We still have 4 months, over a quarter. So a lot of things can change over a quarter. So I think this bias that's being priced into the bond market is a little too aggressive for my liking, which is what's telling me that bonds may cool off than not. Technically, however, if you were to ask me, I would say they look ready to go higher. And remember, the bond market always discounts everything ahead of time. But again, I'm just very shocked to see that there is almost a 30% chance that the Fed is going to start lowering rates in March. I think that's getting a little bit too quick. We've got Fed minutes coming out on Tuesday. I don't think we're going to get any insight at all. I think it's going to be just a confirmation of what we've been seeing. We're making progress. Things are getting better. We don't know for sure what's going to happen. Let's just hold off and wait. And it makes perfect sense right now. It does. It didn't make any sense 6 months ago, but now it does. You've got NVIDIA, Zoom, Baidu, Lowe's, or Urban Outfitters, Dick's Sports, and Best Buy. So there's still quite a lot of retailers, chips and retailers, chips and real estate. The rhyme this week is going to be chips, real estate, and one more sector that I'll talk about in a second. Chips, real estate, and One more. I'll talk about it in a minute. Retail. That's it. So Europe down just a hair, not really moving, and I'm expecting a lot more of that this week in this market. Remember, if we're up 10 points, down 20 points, you're not going to have much of a range. So we're limited by the stock market. Remember, we derive everything from the stock market. Stock market is always ahead of the stock. And if the stock market's doing this, you're not going to have stocks doing that. So again, China closed higher, getting a little tailwind from China. They left their lending rate unchanged. They're struggling right now with the real estate market. Nikkei closed lower, touching a fresh 33-year high before backing off. Robust earnings, prolonged weakness in the yen, and corporate governance reform is what's causing the Nikkei to gain 28% this year. I also think it's the fact that they have a new prime minister, and I think they are edging to start increasing rates. I've been talking about it for the last 7-8 months, and I think it's going to happen. Microsoft gained. They're going to appointing Sam Altman, the co-founder of OpenAI, was ousted last week. The internet is buzzing on this like there's no tomorrow. I wouldn't pay too much attention on it. I'm not big on corporate gossip, and I think Microsoft is already reacting appropriately. Bounced off the ADMA and it's swinging high. Boeing is doing well pre-open. Retail is doing well pre-open. Markets, generally speaking, are doing pretty good pre-open. Energies are higher, even though, as I mentioned, there was some, I think, a ceasefire over the weekend, which I would think caused energies to go down. But again, what the hell do I know, right? If you look at the energies, they haven't been doing well. They're kind of hugging the 200-day moving average. Now, let's talk a little bit about sectors. So this week, I am very, very interested in, here, let me just show you. Home builders. Home builders are doing really well. The Fed data is coming great. And remember, the Fed is starting to lower. So there would be a good reason for home builders to rally. And if you could see here, home builders are doing really, really well. I'm definitely going to be looking at home builders this week. Right here. Right there. So you have some resistance at 85, but you still have, it's only at 83. You still have some points. I like this right now. I like this a lot. So one of the sectors I'm going to be looking at is home builders because they're doing better. Permits are coming up. Interest rates are on their way down. Home builders does not look bad right now. Real estate, XLRE, the bigger brother. Let's take a look. Oops. Real estate, not as good. I would want to see it break above the 200-day moving average first. The 200-day moving average is at 36.62, but home builders. Remember, real estate has a lot of commercial space in it, right? And commercial real estate's not doing really great right now. So I would focus a lot more on home builders. The other sector that I'm really liking is semiconductors. Well, let's first take a look at NVIDIA. Look at NVIDIA. NVIDIA is doing fantastic ahead of earnings. And if you look at price action, you'll see that it's literally sitting at a swing high right here. And it's already past that. I like NVIDIA. And based on what I'm seeing right now, earnings are going to be good because look at what the stock is doing. I mean, it's amazing. Also, look at the semiconductor sector. So I'm very, very bullish on chip stocks this week. And I'm very, very bullish on NVIDIA this week. And generally speaking, I'm bullish on semiconductors. If you look over the last week, where are they? Where are semiconductors? Semiconductors are right here in the middle. Not that bad. If you look at the last 3 weeks, semiconductors and home builders. Look at home builders and semiconductors and tech. And look at the last 6 weeks, home builders, semiconductors. And the average, home builders, semiconductor, technology, real estate, retail. Let's look at retail. XRT. Not bad, but kind of playing around with the 200-day moving average and looks like it needs to break out a little more. Moving higher, but I would definitely this week focus on home builders and semiconductors. Ticker symbol SMH and XHB. That's where you want to be. You don't want to focus on the short side right now because stocks are trading above the 200-day, the 50-day. We're breaking out higher, but you do want to look at home builders and semiconductors. Very, very important. And I'll give you more details as the week continues. Now, before I let you go, I've got something really important for you, and I hope you pay attention. When we first launched the Pro Trader dashboard last month, I knew it was going to be big. You guys knew it was going to be big. That's because it's the only tool in the market that helps retail traders see what institutional traders are looking at when they're trading, day trading, and swing trading. It's that good. It focuses only on what the institutional traders are doing. So you could look at the market from you're forced to look at the market from their perspective. Boy, oh boy, I didn't know it was going to be this big. This big. It's big. I mean, it's huge. I can't tell you how many emails I've gotten from people ecstatic about this tool, how it's helped them day in and day out and how it's helped them with their day trading and their swing trading game. I mean it. I'm not joking around. I don't have to say one good thing about it. I've got hundreds, literally, probably close to 500 emails at this point. No joke. No joke. I'm going to honestly host another 100% live trading session at 1 p.m. today for anyone who wants to have another sneak peek at it. Look over my shoulder as I scan the market for hot new trades using the Pro Trader dashboard. All you've got to do is click the link below and check it out. You probably already have it. If you don't, you definitely want it. I think we had, for the first 2-week win rate, close to 100% over the last 3 weeks. I mean, it's been crazy good. People are very, very happy with it. I'm very happy with it, and it's only going to be expanded and developed even further. This is how you should be looking at the market day in and day out. This is something that you will not find anywhere else. I've put together every little part of what institutions look at and how they decide to trade, and I've put it together in one dashboard for you. Check it out. Follow the link below. I'll see you later. If you have any questions, Roger@rogerscott.com. Bye.